Assalamu alaikum friends, welcome to question number 2 from your SBR textbook, SBR Kaplan textbook. So this is about selling of shares, selling of a subsidiary, and we have a financial instrument. So we are going to cover this too in this question. So Pineapple is a public limited company which has investments in a number of subsidiaries, and reporting date is 30th September 2003, and it prepares its financial statements in accordance with IFRS standard. So in first para we have sale of shares, and the second we have an interest-free loan which is dealt under financial instruments. Okay. So now first let us read the requirements. Requirement A, you have to discuss how the sale of the shares will be accounted in the consolidated financial statements. And B, you have to correct the treatment of the interest-free loan in the consolidated financial statements. And you have to provide the adjustments that are required. So A and B are dealing with two separate things. First, let us finish the sale of the shares. Okay. Pineapple acquired 70%, $2 million $1 ordinary share. Okay. Several years ago, and cash consideration at that date when they have purchased it was 4,900,000, and at the acquisition date retained earning was 2,045,000. Fair value of NCI was 1.6 million. On 1st of October 2002, the retained earning was this much. If you see, retained earning increased from the date of acquisition till 1st of October 2002, and they made a profit also 568 on this date. And on 31st March 2003, okay, they sold their entire shareholding. This is very important. Sold is entire shareholding means what? They entirely sold this 70% completely. That means now they'll be having zero, right? But you have to see the date when they are selling it. It is on 31st March 2003. Okay, the year end is 30th September 2003. So from 31st March 2003 until 30th September 2003, they will be no longer a subsidiary. Why? Entirely selling. It will become from 70 to 0. That means they are losing the control. They will be no longer subsidiary. That means you cannot consolidate for the last 6 months. You can only consolidate for the first 6 months. That is the meaning of this. For how much you are selling it? 5.6 million. The sale proceed. Goodwill is impaired by 40%. Okay. And Satsuma is geographically and operationally distinct. It is geographically as well as operationally distinct from the rest of the Pineapple Group. The reason why they are saying whether it's distinct or not is for IFRS 5, non-current assets held for sale, whether it's a discontinued operation or not. Because you are selling entirely, right? So it could be a discontinued operation also. Whether it is a discontinued operation or not depends on whether it is geographically and operationally distinct or not. That's why they have given you this information, right? So now the next one is relating to the interest-free loan. We'll come to that later. First we'll finish A with it. Okay. So let's see. Sale of shares in Satsuma. Okay. So first of all, before you actually calculate, make sure that you understand the scenario. Okay. They are controlling. The parent is controlling the subsidiary only for the first 6 months. That means consolidate only for the 6 months. After that, when you are selling, you are losing control. Okay. So when you are losing control, what do you have to do? Net asset, the goodwill and the NCI, you have to de-recognize them in the consolidated financial statements. Very important. What are the three things? Goodwill, NCI, net asset, de-recognize. When you're acquiring, you recognize these things, right? Net assets, NCI, and consideration, and get the goodwill. When you are selling, de-recognize it. Selling means not all selling, but when you're losing control. So when you're losing control, you have to calculate a profit or loss on that sell. So you have to calculate. It could be a loss, it could be a profit. Okay, in this case, a profit on disposal. Okay. So how do you find the profit on disposal? When you're selling something, you find the carrying amount of that asset versus the proceed that you are receiving. The proceed that you are receiving already is 5.6 million, right? Proceed from disposal. They are selling it for how much? They are selling it for 5,600,000, the entire shareholding. So this is the sale proceed. Now you have to do the workings for the others. Others you will not get straightly. You have to do some working before you de-recognize it. So let's start with the consideration. What consideration? Goodwill at disposal. You first have to find what is the amount of the goodwill. One by one, we are going to deal. What are the three things you are de-recognizing? Goodwill, net assets, NCI. So first, we are going to deal with the goodwill. Okay, one by one. Don't think about net asset and your NCI at now right now. So for goodwill, how do you calculate goodwill? What are the things you need for goodwill? Consideration, NCI, and fair value of net assets. And at the date when you have acquired it for the first time, right? So what is the consideration at that date? Okay, let me highlight it for you. It is 4,900,000. You have bought it at that date because goodwill you calculate at the date when you bought it. So 4 billion. I will highlight it like this so it's easy for you to reference. NCI also they have given you already. What is it? 1.6 million. This is the NCI, fair value of NCI. So that as it is you can take. On the date of the accusation you have to take this. Sorry, at disposal. But obviously consideration NCI they have taken it at the date of accusation, and if there is any changes they will let you know that this is the amount at the date of disposal. Net asset will change, right? 2000 plus 2045 fair value of net asset at accusation. This you have to take it at accusation only. So fair value of net asset, what is the net asset? If you see, okay, net asset you have to take the 2,000,000 $1 ordinary shares, that is 2 into 1, that is 2000 from your ordinary shares, and this is your retained earnings. So add your retained earnings and your ordinary share for net asset, only that much, and get it. Once you deduct it, you get the goodwill at accusation, and you deduct the impairment. 40% is the impairment. From there you take and then. So this is your goodwill 1473. Okay. After that, now we are moving to the second item, which is the net asset at disposal. So goodwill part is over. We got the amount of we were calculating goodwill here to get this goodwill amount. Now net asset at disposal. So share capital 2 million. Retained earnings is 2342. Which retained earnings are you taking? At the date of disposal, not the opening retained earnings. Okay, share capital will remain the same, but your retained earnings changed. It increased to this amount. This retained earning you are taking. Okay, and the profit, obviously you have to take the profit to disposal date. So what is that profit? Profit is 568. You are taking only for 6 months. Okay, because you are disposing in the middle. So this profit they told it the year enter this one, and profits acquired evenly, so you can just take 6 months of it and add it and get the net asset at disposal. This is the net asset at disposal. Now we are coming to the NCI part. So net asset and goodwill, this keep it inside in the second column. Okay, this is not you are not adding goodwill and net asset with this 5600, the proceed, don't, because this is in the third column and this is in the second column. We still need NCI. Understanding? So NCI at disposal, everything at disposal only you want to know. Goodwill, net asset, and NCI. But goodwill you calculate in the beginning only, that only you take it at the date of disposal. But net asset and NCI, there are changes. So for NCI, what is the NCI at accusation? 1,600,000. From here you can take this NCI. Okay, now NCI share of the post accusation net asset. What is the post accusation share of net asset? NCI is 30% because you have acquired 70%. Okay, and you have to take the NCI share of impairment also because this is a fair value method of NCI. So what is the impairment? Impairment is here, you have already calculated it, 982. On that take 30% and deduct it. And net asset, so post accusation net asset, how do you get the post accusation net asset? It is 4626 minus 4045. This is the same as this because this is the net asset at disposal only, minus the uh, net asset in the beginning, that is 4045. This net assets at accusation. Okay, where you have just added the opening share capital with the retained earnings that you deduct, and on that take 30% because NCI share only you are taking here. 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30% 30 and deduct. So in the second column, you add this both and deduct your NCI. Add goodwill and net asset, deduct NCI. And that the total you take in the outer column, this one, and deduct it from your sale proceed. Sale proceed is 5.6 million. So sale proceed is higher than this carrying amount. Therefore, it's a profit on disposal, 980. Now, remember they told that it is geographically and operationally distinct. Therefore, it's a discontinued operation in accordance with which standard IFRS 5? Because it is operationally and geographically distinct. Okay, so when it is a discontinued operation, how do you present it? You present it as a single figure on the statement of profit and loss in the face of that one only. Okay, that means any profit that you make up until the disposal date, you will write it there. Okay, and also the profit on disposal. So this profit from discontinued operation, it will be known as profit from discontinued operation. You have to calculate it like this. Profit to disposal date. This was the profit you used to acquire evenly throughout the year, 568. Take 6 months of it. With that profit on disposal, this 980, this one. Whatever just now you have calculated it, take it here and add. So this, the total profit will be known as profit from discontinued operation. This is how you will write it. Now we are coming to part B. Financial assets. Before coming to financial assets, you should know what is it. But we'll read the case study first, because this is more trickier and tougher for candidates than the section A. Okay. So on 1st of October 2002, Pineapple made an interest-free loan of how much? 1,500,000 to Blueberry, a key supplier that was in financial difficulties. Who made an interest loan? Pineapple. The company made the loan. So company made the loan means company is going to receive the cash flow. For them, it's not a loan. Okay, they are not taking a loan. They are giving loan to someone. To whom? To the key supplier. So this loan is repayable on 30th September 2006. And it was on 1st of October 2002. That means 4 years. So if the supplier had borrowed the money from bank, they would have charged an annual interest of 12%. But you are giving an interest-free loan. That is no interest. So they recorded the cash outflow, the pineapple, and a corresponding financial asset of 1.5 million. Why? Because the interest-free loan is 1.5. It's an asset for you. It's a financial asset for you, right? Because you have given the loan. Whenever you are giving loan to someone, it's a financial asset for you because you're going to receive cash from that loan. So it's incorrect because you cannot recognize this whole amount as financial asset, 1.5 million. We'll see why. And no other accounting entries have been made except to correctly record the required loss allowance. Why required loss allowance? Because they are in financial difficulties. That means there is a high chance that this will become impaired. Credit risk will increase. But that is not our concern. Okay, we don't have to work on that. We have to work on the amount of the financial asset, how much it will be. You have to calculate that. So financial asset, which under financial asset also there are 3 standards: IFRS 7, IFRS 9 and IAS 32. So we have to deal with IAS 32 presentation. Okay, how do you present it? Whether as a financial asset or a financial liability or an equity. This is a financial asset only, right? So it will fall under financial asset. So according to IAS 32, what does it say? This is a loan, by the way. Okay, so loan is a financial asset because they have a right to receive the cash. You have to say why it's a financial asset. Because whenever you have a contractual right to receive a cash, it's a financial asset. And also their business model is that they will hold this financial asset to collect the cash flow. So according to IFRS 9, how should you measure it? How should you measure this financial asset is very important. Once you identify this is a financial asset, here for the simplicity, they have already told that this is a financial asset. Most of the time they don't say it's a financial asset. They will just say it's a loan, interest-free loan. You have to identify what is it. But in this case, it's easy. We know it's a financial asset. And financial asset, how do you measure it? You measure it in this case using at amortized cost. Why? Looking at the business model. Whenever you have to decide at what to measure, look at the business model. Are you holding the financial asset to collect the contractual cash flow? Then amortized cost. Otherwise, if you're selling it, the financial asset, that means the loan you're selling it, you're not holding it, then you are using fair value through other comprehensive income or fair value through profit and loss out of this two. But in this case, it's amortized cost you're measuring at. This you have to first identify it, right? Now, we have to deal with the fair value measurement because financial asset have to be initially it has to be recognized at fair value initially. Okay, So that's why we have to use the help of IFRS 13 also. Even though the question is about a financial asset, financial instrument, but we do need help of IFRS 13 here, fair value measurement. Because you have to measure it fair value, and fair value is not given to you. And now they have defined what is fair value. It is an asset which will price at which an asset will be sold in a normal business environment, right? Between the market participants. So the price that they have told that this is the financial asset is what 1.5 million. But is it the fair value of the asset? No, it cannot be. Why? Because this is an interest-free loan. But normally in the bank, if you give this loan, they will charge an interest of 12%, right? So that means market participants. Who are the market participants here? The banks. They will not lend this money for interest-free. This 1.5. They will charge interest on this. How much? 12%. 12%. Clearly they have mentioned. So how are you going to calculate the fair value now? Now it will be calculated as the present value of the future cash flow. Remember the three levels? Level 1, level 2, level 3 in measuring fair value. 1, you look at the market and take the price as it is because your goods are similar and same. In this case, it's not similar because your one is interest-free loan. Market is providing a loan with interest. So it's not step 1. Step 2, similar. It's not same, but similar. In this case, it's not similar also. It's not same, it's not similar also. So we have to use the stage 3, level 3. What is level 3? You have to use your own technique, present value of future cash flow, because you cannot define the fair value. That's why this fair value you are calculating using the present value of the future cash flow. That you can do. We know the cash flow, we know the present value. How to find the present value? Using the discount factor, which is 12%, the interest free, the interest. So the market rate of interest. In the market, what is the interest that they are charging? 12%. And it is from 2002 to 2006, right? 4 years. That's why if you see here, it's to the power 4. So it will be 1,500,000 into 1 divided by 1.12 to the power 4. 1.12 because it's 12%, and to the power 4 because of 4 years from 2000. You are finding the present value, right? Of 1.5 million. So definitely it will be less than 1.5 million. It will be 953,000. This is the amount. Understanding? So that means you have to bring down this asset. Already you have recognized 1.5 million. Bring this down to this. Okay, the difference between these two. So you have to write it down. How are you going to write it down? It's a loss. There will be a loss. Loss will be charged in the profit and loss account. Debit this much and credit the financial asset, because financial asset value will go down by this amount, 547. Now remember, you are measuring the financial asset at amortized cost. So when you're taking it amortized cost, any interest income, you will be having an interest income. Why? Because you are giving the loan to someone. So on that loan, first of all, the loan amount you will anyway get it. And what about the interest? Interest also you will get now. How much interest will you get? At what rate? Effective rate. What is the effective rate? The 12%. What the bank is charging. Normally the others are charging that interest only. You also will have to charge. It's already given to you, 12%. So on this 953,000, after you have discounted, then you will apply 12% on that, which is, this is the amount. If you are getting some decimal, ignore the decimal and make it into the full number, whole number, okay? So this you have to recognize. Where do you recognize interest? Profit and loss account. So that interest you will add with the financial asset. That's why it will increase your carrying amount of the financial asset. Just think it as a loan. Value of the loan and you add an interest, so value of loan goes up. Same way here, the value of the financial asset will go up because of the interest. So you debit the financial asset because financial asset value will go up, and you credit profit and loss because it's an interest income for you, income, credit. But at the reporting date, at the year end, they will have a carrying amount. What is the financial asset carrying amount? Amount will be this much, the present value of future cash flow 953,000 with the interest, which is 114,000. Add the two, this will be the amount, 1,067,000. Okay, understanding? So this will be the amount that they will receive at the year end. So that's it. If you are thorough with your financial instruments, especially financial asset, you will understand this better. Okay, if you're having some difficulty, go back to my IFRS 9. I think there are 10 parts to IFRS 9. Out of it, you need to go to financial asset. Okay, I don't remember the order, but it's there under my SBR lectures. You can go back and always check. Okay, till then, thanks for watching and see you in question number 3.